It was a global stock market celebration here today. The S&P 500 was up over 1.2%. We saw that 87% of the stocks within that index were up today, and all 11 sectors were up as well. Not only that, but we had a falling US dollar supporting price activity in the overseas markets. We saw commodities rising today. We saw bonds up today. It was an extravaganza. So we'll talk about all of that in tonight's video and see what it means for our postures. We'll take a look at some of the macro conditions that exist out there, see which factors are tilting in the favor of the bulls versus those that are tilting in the favor of the bears. We'll take a look at sectors. We'll take a look at a number of new sector ETFs that have been announced. And then in our trade application example, I'll focus on a very popular stock in the Dow Jones Industrial Average that actually has news hitting in the after-hours session tonight. And we'll see if we can play that successfully as a swing trade moving forward. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's June 15th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. Also, at the bottom of those emails, you'll find which stocks are giving you overbought and oversold cluster signals. For a while there, we had quite a few oversold cluster signals, but I've noticed that the scales have tilted now towards the overbought side of the equation. So we'll see what tonight brings in that regard as well. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet. And then last but not least, we do have a presence on Facebook. Feel free to follow us at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. Once again, it was a glorious day for the bulls, up well over 1%. And not only that, but it was a broad-based rally. Stop me if you heard me before, because I've been saying that a little bit more often here recently, it feels like. You know, for a while we kind of went through that phase where you didn't really have much in the way of additional participation, but it seemed like the generals certainly cleared the pathway and ushered in the era for all of the militia men and women in the army behind the generals, and they have now come in firing from all sorts. So it's been really fun to watch and witness as there's a lot more participation here across the board more recently. So let's get started with what we can discover out of our heat map here. First of all, let's maybe get started with what wasn't working today, because there are so many green ones out there. It's a little easier to identify the red ones when they're in the minority like they are right now. So let's get started with the big kahuna down in the lower left-hand corner, and this is NVIDIA. Now, some of you that follow me on Twitter probably sensed my enthusiasm around NVIDIA yesterday for one specific reason, and that is my top-down trend trading class that I teach on Monday mornings was able to lock that down as our 10th coffee can stock. For those of you that are not familiar with that concept, I brought it up a time or two here, but not all of you, of course, watch all of these videos. So what we do in that class is we have 25 active trades that we hope to trade from a trend perspective, so not a swing trading perspective. So think about like intermediate term time period. So months, not weeks, is the way that you would think about trend trading. And if we are fortunate enough to latch onto a strong enough trend that ultimately turns into a double or more for us, we then sell half of our shares when that achievement is made, and we basically extract our original cost basis out of that position and then play with the house's money on the rest. So just using really rough math, if you had $10,000 that you put into a stock and then it ends up doubling, that is now worth $20,000. So when you sell half of your shares, you're basically taking the original $10,000 back out of that position. And NVIDIA was able to accomplish that for us yesterday. And what was unique about it is how quickly it all unfolded. We only bought NVIDIA back in February, and just since February, it has doubled for us. So it became our 10th coffee can stock in that particular class account. And we will see what happens in the future. Even if it is a massive artificial intelligence bubble that completely implodes from this point forward, we can never end up losing money in that NVIDIA position since we extracted our cost basis out of it. We, of course, hope that doesn't happen, and we hope it keeps on roaring higher. How unlikely that may be. But we shall see. Stranger things have happened, but it was nice to have a bit of success with that one here more recently. Remember, when I've been telling you guys about some of those coffee can positions in the past, you may have recalled that some of the other coffee can positions we have there are Microsoft and Alphabet, in addition to Synopsys. But those are all kind of, here's that Synopsys one right there. Those are all somewhat AI-related names, right? So now that we've got a kind of a permanent position in Alphabet, a permanent position in Microsoft, and a permanent position in NVIDIA, my top-down trend trading class is well positioned if artificial intelligence truly is the next big thing. We've got the big kahunas in there. With Microsoft and Alphabet, interestingly enough, they became coffee can stocks for us a couple of years ago, well before there was this, craze around AI. That was kind of in the year after COVID when those ones went higher, but just by happenstance, they are now thrown into the AI conversation. And so those will be our workhorses moving forward, along with a number of the other coffee can stocks that we have. So that was really exciting for us yesterday. And remember, we never know when these things will top out. And today, NVIDIA was down 0.8%. So in a way, I'm glad that we were able to sell half of our shares yesterday at $428 because today it's already $1.50 lower. Now, of course, that doesn't mean a whole lot on a $420 stock, but you just never know when something tops out. One of the interesting elements of the Microsoft one, we had talked about this a little bit in my Q&A class today, is that when Microsoft became our coffee can stock, in other words, when it doubled for us, it was on November 22nd of 2021. A reason that number rolls right off the tongue for me is because that ultimately ended up being the all-time high price for Microsoft, and it was the all-time high for the NASDAQ. And so it's just kind of interesting that it shook out that way. Had we decided we wanted to wait an extra day or two to sell half of our shares, we would not have been able to accomplish it at the price that we wanted. So that was kind of interesting how that shook out. But the other interesting thing is Microsoft is knocking on the door once again of hitting all-time highs. You'll notice today it was up 3%. Remember, this is a massive company. It's a $2.6 trillion company that was up 3% today just because the market was up. And it is very, very close to those November 2021 all-time highs here all of a sudden. And how many people would have guessed that, last year when it was in what felt like a death spiral with a lot of other tech stocks? Well, here we are knocking on the door of all-time highs for Microsoft once again. So Microsoft up 3%, Apple up 1.12%, NVIDIA down 0.8%, and Alphabet up 1%. So those are kind of your big fish in the tech-related areas. You could also throw Amazon and Tesla into that conversation to a degree. Amazon had a reasonable day. It was up 0.55%. That actually underperformed the market at large. Nonetheless, a green day for it. However, Tesla finally ended its win streak. Can't remember how many days in a row it was. I think it was either 13 or 14 days in a row that Tesla had been up. It was its all-time high in terms of that streak. It had never accomplished that before. And Tesla's been on quite the impressive run of its own so far in 2023. But today it finally took a breather. And for the people who are bearish on Tesla, which I think there's a lot of them out there, they have to be a bit disappointed if this was their big sell-off moment, right? You can imagine being somebody that was shorting it up every day and then waiting. You just telling yourself, well, surely it's going to give some back. Surely it's going to happen. And then finally you get your sell-off day and it is down by 0.3%. Not gonna help your cause all that much in that regard. So we'll see if that leads to any other further selling in the future days. But for right now, that was basically an afterthought type of a day for Tesla. In terms of other large players out there, let's talk about Meta. Meta's actually in our top-down trend trading class as well. However, it's not yet a coffee can stock. It is still part of the 25 stock actively traded portion of that. But we were happy to see that it was up 3% here today. You also saw that Berkshire Hathaway had a nice day, up 1.17%. United Healthcare came firing back, up 1.3%. Remember, it was down pretty big yesterday, so had a little snap back there. We had JP Morgan, that was up over 1% today. ExxonMobil was up about 0.69%. So those are kind of some of your bigger key players out there these days. You can maybe talk about Visa and MasterCard as well. They were both up over 1%. So, it's hard to pick and choose amongst those green squares and rectangles out there because there was so much bullishness out there today. I would also point out that Oracle was in the news to a degree today. Their founder or chairman, Larry Ellison, just keeps on moving up the ranks of the world's richest people. And I don't know if he ended this way, but in the middle of the day today, I saw that he surpassed Jeff Bezos in terms of worldwide wealth rankings. Sometimes people forget how wealthy he is. He owns his own island and all these other things. But anyway, Oracle has quietly become a beast out there. It doesn't have the market cap of something like Microsoft or Apple or Nvidia or what have you. But Larry Ellison still has such a huge portion of it that it doesn't really matter as much. So anyway, it was another great day for Oracle, up 3.5%. I should also point out that Adobe was up 2% here in the normal session today. However, they reported their earnings after hours here tonight, and they were up yet again. So I didn't see where it shook out when it was all said and done, but it was a big move. I think when I initially glanced at it, it was up like an additional 5% after hours. So the good times keep on rolling for some of those tech names in the after hours session there as well. In terms of any sort of consistent bearishness out there, I would say the only thing that really catches my eye from that perspective is semiconductors, right? I can't even say more broadly technology sector. I can only say the semiconductor industry within the technology sector did have overwhelming bearishness. Of course, Nvidia being the key one that I mentioned before, but you could also talk about AMD, which was down 2.4%, Broadcom that was down 0.3%, and then AMAT and Lam Research and KLA Tencor, they were all down a bit as well, but not nearly as important companies these days. So that's probably the only kind of consistent pattern of selling that we saw today was semiconductors. You have a smattering of some of the hotel and travel related names, with Marriott and Las Vegas Sands, Hilton, they struggled a bit. And then you had a little bit of bearishness in real estate as well, but it really wasn't much, not even 1% types of moves. So today was a great day for the bulls once again. We've had several of them lately. Let's go ahead and take a look now at what the specific numbers were on the main part of the platform. And you can see that 435 stocks out of the S&P 500 were up today. And so that's good for about 87% of the index closing in the green. Again, this was not just a narrow market today. This was a broad-based advance with the vast majority of stocks closing in the green and in many cases closing substantially higher. Right? Sometimes you have a big move in the market and each consecutive day after that it's led by a move that's slightly smaller than the prior day. Remember, this is like the 5th or 6th day in a row that the S&P 500 is up, and it kind of feels like today was like the Big Bang day, right? The day where it's actually going to the upside towards the tail end of the move as opposed to at the beginning. So that's kind of interesting there as well. Let's take a look at those charts now. You can see here, S&P 500 was up 1.22% today. And anytime we're up or down by more than 1%, I like to show this chart 6D here first because it helps us understand, if there's been more volatility, less volatility, that sort of thing in a slightly different visual format. So a reminder for those of you that are newer to watching the video, this area right here in the middle will kind of show us through the green bars and the red bars how aggressive the movements of the market have been here more recently. And there's this black zero line that basically if the market was exactly flat on the day, the candle would be, or the bar would be right on the black line. Otherwise, if the market's up a bunch, that green line will go up. If it's down a bunch, the red line will go down. And you'll notice here in the label, it says the blue line is a 1% move. And so you have your upper blue line right here, and then you have your lower blue line right here. And of course today, again, was a day where the market was up over 1%. So you can see that bar getting up and over that blue line. And what catches my eye in regards to that is that, first of all, let's confirm what I just said a second ago, because I don't have to just guess. I can now see with my own eyes that that is true. So I said a moment ago that it felt like, we were having one of our biggest days after a bunch of up days in a row. And a lot of times it works the opposite way. Your big day is your kind of breakout day at the beginning, and then each successive up day is a little bit smaller. Well, here we are. This is now our 1, 2, 3, 4, 5, 6 day in a row to the upside. And of those 6 days, you can see that today was the biggest performing day for the S&P 500 out of all of them. So, quite the move here, following up yesterday's somewhat mild move. However, yesterday was an important one because the market did not implode upon Jerome Powell's comments and the FOMC interest rate decision to basically skip a rate hike this time around. So not only did we hold our gains yesterday, but we added to them significantly today. And just like I was telling you guys on Tuesday when I was last with you, those are feathers in the caps of the bulls. I don't know how else to put it. This is a bullish market that we find ourselves in right now. There's very few bearish features, at least if you're looking at the charts. So there's reasons that you in your mind could be thinking we should be bearish, but what we see with our eyes on the charts is effectively what we want to see in a bullish market environment. We have a lot of risk-on tendencies of this market right now. Another thing I should mention is we had an IPO today. IPO was Cava. Some of you might recognize that restaurant brand. It's not where I live here in the Rocky Mountain region yet. However, I've seen some pictures on Twitter and elsewhere, and I will look forward to taking advantage of that when it ever does show up on my doorstep. But for those of you, especially out east, you're probably familiar with that Mediterranean chain, and it had a very successful IPO today. It was up 100%. Basically from where it was indicated. Now keep in mind, so the ticker symbol, by the way, is CAVA. So this is going to be a kind of a weird looking chart here all of a sudden, but be aware when you see like on CNBC that it shows that it's up 100%, remember that's only up 100% for people who had access to the insider IPO shares before they were released to the public. So sometimes that's a little confusing, especially to newer participants in the market. This thing, when it opened today, opened at $42. So if you got it on the very first tick when it was released today, you bought it at $42 and you made a little bit of money on it so far. It's at $43.78, but you're not going to be the one. You might wake up tomorrow and pick up a copy of the Wall Street Journal, and it'll say in the headlines, Cava doubles on IPO day. And you might be thinking to yourself, well, how could that be? I literally bought it at the first tick of its release, and I'm only up $1.78. So keep in mind when they're referencing those numbers, they're talking about the actual IPO shares on the primary market, not the secondary market. And all of us retail Joe Schmoes out there tend not to have access to the insider IPO actual primary shares. We have to be relegated to trading the shares after they've been released in the secondary market. So anyway, reason I bring that up right now is because that's yet another sign of bullishness for the market, another feather in the cap for the bulls. You want to see a healthy liquid type of a market where private companies are starting to feel more comfortable going to the public markets for capital formation once again. And, I can't say that one IPO is going to change the tenor of the whole thing. Remember, we have been in a bleak IPO period here for the last, let's call it year plus. we had an unbelievable period that was basically kind of destroyed by the SPACs, right? Not to put all the blame on them, but if you remember that era immediately after COVID, you had everybody who had the opportunity come hat in hand into Wall Street and saying, I'm here for the money grab, right? And I don't blame them. If you needed to raise capital, you got to do it when enthusiasm is at its highest. And we certainly had that after all the COVID hoopla and all the stimulus checks and all that kind of stuff. But, looking backwards now, we can easily see that most of the end investors in those SPACs and IPOs did very, very poorly. The insiders and the company itself did reasonably well because they fulfilled upon their job of raising capital when sentiment was at its height, and therefore they received more money from the public than they probably deserved to. Then we went through this period here last year where it was the exact opposite. You hardly saw any companies doing IPOs because sentiment from Wall Street was not very good. Remember, when a company does an IPO, they do it when it benefits them. They're not a charity trying to say how many new millionaires can we mint out there in the trading community, right? That's not their interest. Their incentive as the business is to raise capital at the highest prices possible. In other words, it's a tug of war between those who buy the IPO shares versus those who issue them. So anyway, I think that was a positive sign, all else being equal today, that Kava did come public successfully, and it was oversubscribed, and the shares did end up basically doubling from the indicated price, and it basically proved to other businesses that might be in the wings that perhaps the IPO market is thawing out a little bit here as well. So yet another sign of risk appetite holding up very, very well here at the moment. The other thing that kind of catches my eye about this chart here now is notice the amount of 1% up days that we've had in the last few months, and then compare that to the 1% down days that we've had over the exact same time period. You'll notice that over the last 2 months, we've had just 3 days that the market has been down more than 1%. Right here on May 23rd, right here on May 1st, sorry, it was May 2nd, and then right here on April 25th. That's it. Those 3 days in the last 2.5 months are the only days that the market has been down a measly 1%. Now compare that to this behavior back here in the worst part of that drop in the autumn of 2022, and we had lots and lots of days over and over and over again where these red bars were stretching down below that blue line over and over and over and over, and now we just went 2.5, almost 3 months with just having 3 individual days. That's it. Meanwhile, you can see all of the up days that we've had over the exact same time. Right there, 1%. There's another 1%. That one's basically 1%. There's another 1%. There's another one that's basically 1%. There's another 1%. There's another 1%. There's another 1%. Even before that, there's another 1% and another 1% and another 1%. And then finally, you get some of these more chaotic days. But this stretches back to when we were dealing with the regional bank crisis. So that was kind of what was stemming some of those sell-off days. But since that calmed down, which basically took place after March 22nd, we have now just had 3 days where the market is down 1%, and we've had lots of days where the market is up over 1%. That's another sign of bullishness that we see out there. One thing that's a little peculiar to me, and I'll have to verify this here real quick, but it's catching my eye right now. Remember that this purple line down below represents the pathway of the VIX. What's weird about this is usually when you get a massive up day for the market, the VIX goes down, right? Those two things they tend to be inversely correlated. But from my eye's perspective, it looks like the VIX was actually up today. Not maybe a whole lot because the VIX is still only at 14, but it does look like the VIX was up. Let me just verify that by pulling up the VIX on the chart up above as well. And yeah, my eyes are not seeing things here. That is absolutely true. The VIX was up today, and I don't know the reason behind that, but it is a little peculiar to say the least. So does that mean that there's some underlying bearishness waiting in the wings? Who knows? Maybe it's just a response to the fact that we are at such depths right now that you were bound to have some sort of a reversion type of a day despite the bounce in the overall market. So don't know if we should read too much into that or not, but I will just point out that it is weird. It doesn't happen a lot when you're up over 1% in the S&P 500 and the VIX is up on the same day. But again, let's focus on like the context and perspective of this situation. The VIX literally just hit multi-year lows here at 13.5 just last week. So the fact that we're up at 14.5 still leaves us tremendously lower than where we had been in the market traditionally over the last year or so. Remember, it was kind of a big deal when we got down below 20. Now we're way below 20. So anyway, that's another thing that I think is noteworthy about today's action. And we'll see if it means anything moving forward. But in general, this is a day that has a lot of bullish features, as has been the case for quite some time in the market. Let's now do our traditional foregrid, and that will be chart 4B. And no surprise, because of course when I was with you on Tuesday, we had strongly bullish postures across the board. Here we are just 2 days later, and most of these charts are hitting multi-month, if not yearly highs. And when that happens, there's the tendency of the posture to stay the same, and that's exactly what's happening right now. So let's go through them, and maybe we can kind of separate them from the two charts on the left and the two charts on the right, similar to our conversation on Tuesday. The reason I'm doing that is because you can see once again these green tags are showing up on the chart of the S&P 500 and the NASDAQ composite that say yearly high today. Remember, these charts that you're looking at here are showing you just the last 3 months, but this label is designed to look back at the full 52 weeks. So it goes beyond what you see on the charts visually here. And it does confirm that we are in a very bullish market environment right now, right? It's hard to make the case with a straight face that you're bearish of the stock market if the market is literally hitting 52-week highs. And that is what is happening right now and has been for the last 3 or 4 days. So the S&P 500, another solid 1.22% move today. You can see some of these year-to-date numbers are very impressive, up about 15% year-to-date. Even looking back on a 1-year basis now, the market's up 18%. Again, not down 18%. The market is up 18% from where it was on June 15th of last year. That has been a very impressive run, despite what felt like a really nasty decline back in September and October of last year. And then again, take a look at the size of today's candle. Very impressive. It's bursting just to go higher, right? It's taking any excuse it can to go up, 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 and away. Notice that the green line, of course, is in that strongly bullish not overbought, but upper reversal zone is how we kind of phrase that. And it only goes to 100, and it's at 96 right now. But remember, it can stay in the upper reversal zone for long periods of time. And therefore, just because it's there doesn't mean that somehow that's a sell, right? That would have been a major mistake had you said, oh, well, green line went into the upper reversal zone here on this day. Well, look at where we're at right now. It went from 4,200 to 4,400 in a straight line. So it is a reminder. That's why we offer that kind of grace period on that indicator and wait until it falls out of the upper reversal zone before we start getting a little bit more concerned. And even then, it doesn't have to be a big thing. Then it would just go to weekly bearish posture, and that's still not even strongly bearish. So it works in progressive movements. And right now, we are in a sign of strength and bullishness in the market. Notice down below, oh, by the way, we are still above the rising 30-day moving averages on all 4 of these charts as well. So all 4 of them have strongly bullish market forecast intermediate postures. All 4 of them are trading above their rising 30-day moving averages. That is generally very bullish in general, right? It's hard to claim that that is something that is bearish. Sometimes you get to a point where you have too much of a good thing, but that's kind of a different conversation entirely. There are some people out there that actually think we're still, in bearish conditions, and it's like, well, what charts are you looking at, right? Because these charts are looking mighty fine here to most people who are reasonable with themselves, right? Sometimes you you play head games with yourself and say, well, just because I know, this statistic or that statistic, then, my posture is bearish. And it's kind of like, if you're honest with yourself and you're looking at the charts, what do you actually see? What are your eyes telling you? And the eyes right now should be more bullish than bearish in most cases. The chart on the bottom left here is the NASDAQ Composite. And of course, that's been our workhorse of this market for quite some time, which is where you're going to find a lot of those AI related names that I had mentioned before, your Nvidias and Microsofts and Alphabets, and those types of fun tech stocks are usually structured at a greater percentage within the NASDAQ Composite. And so this is not any new information. It's basically what I've been telling you guys for 3 months now. The NASDAQ is our leader and it looks good, right? Take a look at this entirety of this 3-month chart. You have stayed basically above a rising moving average that entire time. There has been very little in the way of resistance to that idea. Every so often you come down and you close below the moving average for a day, but it immediately pops back up again. So this has been a pillar of consistency that we're looking at here with the NASDAQ Composite, and it did touch another 52-week high here today, just like the S&P 500. So a solid day out of the NASDAQ, up 1.15%. Notice that it was not up quite as much as the S&P 500 today. So that was kind of interesting as well. Perhaps that's the Nvidia effect right there, with Nvidia closing lower by just a skosh, whereas a lot of the other kind of, cyclical types of sectors that are out there held up their end of the bargain a little bit more than maybe the technology stocks that were outperforming at such an aggressive rate on prior days. Maybe today was a day where they didn't do that quite as much, but still a great day there for the NASDAQ Composite, as its green line is up here at 97 at the moment, and you close near the high of the session here today as well. So a great day for those two, in addition to the two on the right. It's just that their charts look a little bit different because they haven't been quite as bullish in the last couple of months. They've been bullish enough, but not as bullish as the S&P 500 and the NASDAQ Composite. Those things just look perfect almost from a trending perspective. Whereas we can kind of nitpick on the charts with the Dow and the Russell 2000. There's been more bearishness in the middle of it, and it's kind of been a little bit more touch and go with those areas. But the Dow was up nicely today. The Dow actually led, and remember, that's not particularly normal to have the Dow Jones Industrials up the most on a percentage basis on the day when we had a big up day for the market in general. Usually, if anything, they're up the least amount because they're usually the blue chips. Well, there was kind of a strange phenomenon that took place here, and it was likely because of United Healthcare. Remember, the Dow is a price-weighted index. Yesterday, United Healthcare was down tremendously. Today, it bounced back up tremendously. So I'm going to guess that the reason the Dow outperformed today is just kind of the coincidence of how things shook out with United Healthcare. So I'm not going to give you the sense that all of a sudden the blue chip old school companies are the bee's knees compared to the tech stocks in the NASDAQ. I think it was kind of a little bit of a fluke here today. Nonetheless, credit where credit is due. That was a nice move, and it was enough to get the Dow Jones Industrial Average up here to new highs on a multi-month basis. Notice the tag is not showing up for the yearly high the way it was with the S&P 500 and the NASDAQ, but we're not that far away. If I pull up a 1-year daily chart here, you can see that the high that the Dow hit was back here in December at 34,712, and we're at 34,404 right now. Right? If we have one more day like we just had today, in other words, if we were up another 428 points tomorrow, that would be new 52-week highs on the Dow as well. That's how close we are. We're basically 1% away from having the Dow join the S&P 500 and the NASDAQ at 52-week highs. So that was kind of interesting. Another thing kind of caught my eye with the Dow. This is not a great textbook example. Nonetheless, I'll point it out because it caught my eye as well. If you kind of zoom in on the last 6 or 7 months here on the Dow, something stands out to me. Most of you probably are seeing what I'm seeing right out of the gate without me mentioning it, but for those of you that aren't as familiar with looking at charts, this could be an interesting exhibit for an inverted head and shoulders pattern, which is a bullish reversal pattern where you've got your left shoulder over here at the end of December. You have your head down here at the middle of March at the height of the banking crisis, and then you've got your right shoulder that is accentuated by this oversold cluster signal right here at the end of May. And so you could have a nice move higher if you have a breakout of that pattern. Now, the reason I said it's not a textbook example, because this is actually a pretty good example of the shape itself. But the reason I said that it was not a textbook example is typically you want to see an inverted head and shoulders pattern at the bottom of a move. And if you were to go back on a 1-year chart, notice that this formation is happening up here towards a resistance area, not down below here where you would have kind of a nasty sell-off that would have resulted in and ended in an inverted head and shoulders pattern. So that's why it's probably not textbook. Nonetheless, I thought I would point it out because there's a lot of the same psychological elements that are embedded in this pattern that could very well be the catalyst for why the market pushes the Dow higher in coming weeks and months, right? It's a possibility. So let's keep it at least in that camp and on our radar for a possibility. And then down below here, you do have the Russell 2000. It was up 0.81% today, so a solid day out of it, but not a 1% plus day like the other 3 indices. Nonetheless, the fact that it's holding its gains here is at least impressive enough to me, because this 4 out of 5 day rally out of the Russell was breathtaking. Starting with this candle right here and ending with this candle right here, you do not see that type of activity out of a broad-based index all that often. So yes, maybe it's a little bit disappointing that it's kind of just stalled out here, but the way I look at it, it's just digesting these gains. That's a good thing, because if this was a fluke, the market might have been incentivized to immediately correct that fluke by sending it back down. Instead, it's choosing to let it kind of settle in up at these higher levels here. And I think that's a positive sign, all else being equal as well. So all of a sudden, Russell looks pretty enticing. Its green line is in the upper reversal zone there as well. So again, solid day, broad participation, excellent returns. I could go on. So we have strongly bullish postures across the board. We have price above rising moving averages across the board as well. Let's pop on over here to the internet now. I wanted to point out a couple of things here before I get into my typical routine on Twitter. Be aware that I just got done, before I started recording this video, I posted this tweet where I say, when I was at the Berkshire Hathaway meeting in Omaha last month, I bought this flip book of investing quotes from Warren Buffett and Charlie Munger. I'll unveil them one day at a time here in the thread format, starting with this tweet. Hit the bookmark icon to follow along. So I got a question, well, where's the bookmark icon? Because sometimes people aren't quite as familiar with Twitter as other folks. And it is a little bit confusing, because if you're just looking at it on my timeline, you don't actually see the bookmark icon down below. What you have to do is you actually have to click into that individual tweet. And then once you do that, it'll allow another icon to show up down below. And the bookmark icon is this one right here that looks kind of like a little flag right there. And you can see 9 people have already bookmarked it. I can't see who bookmarks it. I can see who likes it. I can see who retweets it, but Twitter does not allow you to see who's bookmarking it. So if you're more of a private person and you don't want me to know that for whatever reason, rest assured I do not know who's bookmarking it, unless somebody tells me, which it looks like right down below here. Trusts and Estate Guys told me he's one of those 9 people so far that have bookmarked it. So anyway, I thought I would point that out, because sometimes people do have questions about little things on Twitter that sometimes I just take for granted that seem like they're stuff that we all know, but I have to remind myself there are some people that just don't do Twitter a whole lot. So while it might be obvious to a lot of you, it's completely new to some of the rest of you. And by the way, if you're looking for the tweets that you've bookmarked in the past, then over here on the left-hand side on your Twitter, you'll then see which tweets you've bookmarked in here. So again, I can't remember how many days this will be, but it'll be probably probably a few months because there's quite a few quotes in there. And what I'll plan to do is unveil these Buffett and Munger quotes one day at a time. So if you're interested in that wisdom, as it says here, sharing over 50 years of insights and wisdom from Warren and Charlie, feel free to follow along with that tweet. And if you're looking for it, just go to my timeline. You'll find it here on June 15th. Otherwise, you can kind of see the web address up at the top here as well, twitter.com/Brandon Van Zee /status/16694753943176576. Okay, now that I've rattled that off, you might have to hit the rewind button a couple of times to get all that. But I think most of you will easily find it if you just go over to my timeline. The other thing I wanted to point out is that I was made aware of something that I did not know about today. It was actually one of our market scholars that pointed this out to me because I did not know. So I have a number of scripts, think scripts, that are based upon the equal weighted sectors out there. Sometimes I bring them up here in these presentations as well, but we mostly use them in my top-down trend trading class. Well, anyway, earlier today I got an email from somebody saying, hey, what's going on with, chart 1E? Nothing's pulling up. And I was like, that's weird because I know it was working on Friday because I look at it every single Friday. So I didn't know at first either. And then I started investigating the situation a little bit more. And unbeknownst to me, all of those equal weighted sector ETFs actually changed their ticker symbols. I'm not sure I know why or if I like it because I was kind of getting used to the old ones. Nonetheless, it happened. So many of you know that Invesco is the fund family that has the RSP equal weighted S&P 500 ETF. It's a pretty popular one. Obviously, SPY from a market cap weighted perspective is way more popular, but RSP has been a really nice way to kind of have further evaluation of the market and try to judge its breadth by comparing RSP to SPY. And so RSP has become a fairly successful ETF. Anyway, these equal weighted sector ETFs are probably a little bit more kind of niche for just a handful of us, but haven't really taken off the same way that RSP has at the broad level. Anyway, you can see that with these ticker changes, they've kind of used a new format on these equal weighted sectors to kind of follow the mindset of the RSP. So again, RSP all by itself will be the ticker symbol for the equal weight S&P 500. So notice like the new ticker symbol for the communication services equal weight sector ETF is RSPC, for C standing for communications, I suppose. And then discretionary is RSPD, and staples is RSPS. Energy is a little different because it's RSPG, so I'm assuming that some other company or business or something like that already had the ticker symbol RSPE. So this one they had to use G instead. But anyway, for those of you that might have been confused by that in recent days, that's what's going on there. There was a major overhaul in the tickers themselves. So remember, I am going to have to kind of redo some of my think scripts for those of you that are premium members and get that kind of hand coded into those think scripts, and then I'll have to reshare those scripts with you guys to then re-import into your Thinkorswim platforms. Again, that's just for our premium members. So for those of you that are just the free watchers of this video, unfortunately, that's not something that we would give away for free there. But for those of you that are premium members, be on the lookout. I will try to work on that this weekend when I can find some time and hopefully get most of that accomplished here before we start trading next week. Also remember that on Monday, we have Juneteenth holiday. This is only like the third year that has been a national holiday. And so a lot of people are still forgetting about that. Remember, the stock market is not open on Monday in the United States. So we won't have our classes at Market Scholars either, but I will be back with you on Tuesday morning for dividend growth investing at that time. So anyway, stay tuned. I will try to communicate any sort of new shared links with those of you that are premium members, probably through our Telegram channel. and then, bring it up in classes next week if I need to there as well. All right, let's now get into our typical routine of me saying thank you to those of you that help support these presentations. As I always say, they take a heck of a lot of time and they push me into the night further than I would prefer, especially when I find things, like what I was just talking about that I also need to do from projects and trying to figure out things and try to respond to emails and all these other things that we have going on as busy business owners. So for those of you that appreciate the effort that David and I take to do these videos for you for free on YouTube, we ask one simple request: click like for us there on Twitter. As I always say, as long as we're up and over 100 likes, I'm more than happy to give you a full-length video the next time I'm scheduled to do it. On the other hand, if you prefer the shorter 15-minute version of the video, then don't click like. And if we're under 100 likes, then I'll just keep it short and sweet the next time I'm scheduled to do it. But this time around, you guys' voice was loud and clear. You wanted me to do the longer form video. So let's do some shout outs here and give some likes away. Thank you to Dennis and to Joel and Ayakipa and Sherry and Teresa and YG and Matt. It's my buddy from college there. He's a great musician, by the way. So for those of you that like piano music, check out Mayer Solo Piano. Anyway, thank you to George and to Sandeep and to Chris and to Ron and Business News and Karen and Michael and Victoria and Linda and Nick and Arthur and Valerie and Ray and Janet and Carlisle and Susan and BZ Japan and Ann and Vernon and Ken. The list goes on and on and on. I can't get to all of you, but I do like to at least make sure I acknowledge you every so often, and hopefully you do see your name pop up here and there when you go out of your way to take those 5 seconds and click like for me. It does go a long way for us and helps encourage us to do the video because we're doing our best to provide education with you for free. And our hope is that we're building goodwill with our community that will hopefully become premium members at some point down the road. Even if today doesn't work for you, maybe 5 years from now you decide the premium membership is for you. But until then, we want to do our best to help educate you guys through these YouTube videos as well. Also, while we're here on the internet, just a friendly reminder that I did teach my question and answer session here today. We actually had about a 4.5-hour class as a result of David's schedule getting changed around a little bit. He's been involved with his basketball camps here quite a bit in the month of June. Many of you know that he helps out with his high school basketball team, so they've got a lot of traveling and stuff that he's been doing. So he's had to kind of rearrange his schedule there a little bit. So knowing that he didn't need the Zoom platform like he normally would after 3.5 hours of my class, I got to go a little bit longer than I would otherwise. So here are some of the questions that we covered today. We talked about Zoom video as a stock and whether it would make for a good covered call candidate. We talked about Leggett and Platt as a dividend growth investing candidate. We talked about United Healthcare and what my opinion is on managing Iron Condor trades in general. We talked about how Florida Power and Light became NextEra Energy and whether that makes sense to look at that as a dividend growth investment. We also had a question from one of our newest market scholars, so welcome to Steve, and he was asking me about Dollar General as a long-term investment, and then if I had any ideas on foreign dividend stocks that might make sense in the blue zone of the dividend stair-step chart. So a lot of great questions there as always. If you are a premium member and any of those topics sound interesting to you, that recording is now posted and available here on our Trading Rooms tab. And then last but not least, let's have a little chat here about the factor selector. Remember, this gets put together on Tuesday night, so it's a couple of days stale by now, but still gives us a general sense at as far as what's happening with the different factors out there. We really didn't have much in the way of changes this week. You can see for the 4th straight week, quality remains number 1, and for the 5th straight week, dividend yield remains last. And in the middle rankings, we had just one switcheroo in the 3-4 position. Value went up a slot and was, replacing momentum there. Now, value was probably helped by the banks, right? The financials have shown an improvement here more recently. So I think it's a case of value doing really well as opposed to momentum losing its gusto, right? I think they're both doing well. I think it's just that value has had a little bit more of an aggressive snapback here more recently because all of a sudden the banks are showing some life. The other thing that I thought was worth pointing out is you guys have sometimes heard me mention that there is a fairly high correlation between the quality factor and the technology sector these days. And if I just go back over here real quick to our website and pull up the sector selector, I want to show you how something catches my eye. Notice, and we talked about this on Tuesday as well, so some of you have already seen this, but notice that technology for the last 4 weeks has been number one. And if you go all the way back here with these green dots, they were number one for the first 5 weeks of this rolling 13-week graphic. It was the 4 weeks in between where they were not number one. Now with that knowledge, let's take a look at the factor selector. And notice quality was number one for the last 4 weeks. They were number one for the first 5 weeks, and they were not number one for the 4 weeks in between. So you don't have to just take my word for it that there's a high level of correlation between the quality factor and the technology sector. You should be able to visualize that with your own eyes right now just by looking at those two things in a compare and contrast style. All right, let's go ahead and now pop back on over here to the main part of the platform. Let's do some 12 grid analysis, starting with chart 5A. As we pull that up, a reminder that the background colors of these charts will be green if the posture is bullish, and they will be pink if the posture is bearish. So it seems like there's maybe a handful more of bearish charts here than there was the other day, and one of them that really stands out to me is the US dollar. Remember, we were talking about on Tuesday how it was a down day for the dollar, but because we had such a big move a couple weeks prior, you were able to retain that strongly bullish posture. Well, here we are 2 days later, and the dollar has done nothing but continued to fall. This is now its third straight down day, and today was kind of the aggressive, cascading type of a day, similar how we had the aggressive cascading day to the upside on the S&P 500. And remember what I've mentioned to you guys over the years, that in my book, it's a lot easier to trade the market bullishly when the US dollar is weak. So I, for one, appreciate this. Now, keep in mind, I don't have any sort of foreign vacation plans here in the near term. So that probably affects my mindset there. Remember, if you're going to go overseas as an American, you'd prefer to have a strong dollar. But as an investor, in the United States, I actually prefer having a weak dollar. And that was what was a little bit challenging about this period right here. But now we've given back more than half of that big move. And we're now breaking below that 30-day moving average. Now, it doesn't mean that it's guaranteed that all of a sudden we're going to go into this weak dollar period, but it just means that, we didn't really see much in the way of, restraint from the bulls at the moving average, and therefore the bears kind of had their way. They were just able to slice straight through that moving average, no questions asked. And usually you'd expect some of the bulls start to show up there. So, that's an interesting development here all of a sudden as well. One thing that was kind of weird about it is a lot of times when you have a down US dollar day, you have the foreign stocks outperforming. Today, the foreign stocks did great. They were both up about 1%, both of those categories. But notice the S&P 500 was up 1.2%. So normally that doesn't happen. More oftentimes, you will find that the foreign markets will outperform the U.S. market. And while all three of them had great days today, you did still have the U.S. stocks slightly outperforming the others. So that was a little bit weird, just kind of like what I showed you before about the VIX. That was kind of weird today as well. That's not what you typically expect. So every so often you get some curveballs like that. One thing I would say now that we're having the conversation about the foreign markets is, remember how emphatic I was on Tuesday when I was talking about EEM with you, because on that day it was this candle and we were breaking out above this resistance area. Well, look at where we're at just 2 days later. Aggressive continuation move out of EEM. That has been a great push out of that area here more recently. And then also, I would point out that EFA, the developed foreign stocks, also has shown improvement from when I was with you on Tuesday. Remember, on Tuesday, it would have been this candle right here that was basically lodged just on the underside of the 30-day moving average. It's gone up the next couple of days, and all of a sudden, things are looking more promising there. Remember, when I was with you on Tuesday, we still had a weekly bearish posture on EFA. So that is something that has changed in just the last 2 days. We now have a strongly bullish posture on EFA according to the market forecast technical indicator. So whether you're in the United States, whether you're in the developed foreign part of the world, or whether you're in the emerging foreign part of the world, you've got bullishness across the board. It's like a global stock market party that is taking place right now. You love to see it. All right. Another thing that we talk about when it comes to dollar weakness is oftentimes the inverse of that is strength in commodities, and that did come through the way that you would expect today. Notice that gold was up 0.7% and oil was up 2.5%. Now, gold had an oversold cluster signal yesterday, so that might have been part of the story. You actually had a bit of a bullish engulfing candle today there as well, but you still have the strongly bearish posture. So we're still kind of in wait and see mode on that chart. Oil's looking a little bit better, but still, it's not a trending chart. It's just a chart that's been chopping sideways. It just happens to find itself back above its rising moving average by the slimmest of margins here today. In terms of the 10-year Treasury yield, we actually saw that slip. Remember, on Tuesday, we were at 3-month highs. Now that we've heard from Jerome Powell, we've actually seen slippage in that for 2 days in a row, and it finished lower at 3.72%. It does retain its strongly bullish posture, however, and remember, on days when yields and interest rates go down, typically bond prices themselves go up, and that's exactly what we saw here with TLT. Remember what I said on Tuesday, that I've been watching this one a little bit closer because we have an iron condor going on it right now in this very presentation. And I was hoping that the TLT could make a move higher to push us back into the middle of those break evens. And that's exactly what the market delivered for me. So thank you very much for gift wrapping that for me, market. We are going to be good to go and have a max gain on that particular iron condor tomorrow. However, remember there's other trades that are a little bit dicier. So we're going to have to babysit some of those positions. Make sure you remind yourself that tomorrow is June options expiration day. But anyway, TLT benefiting us here with a move higher. We're back above the moving average, which itself is still falling, but we now have a weekly bullish posture on TLT as the long-term U.S. Treasuries. Foreign bonds continue to be a little bit struggling here. It was up a little bit today, just a bit more than break even, but you can see we still reside below the falling moving average. We continue to have strongly bearish posture. And then high yield bonds, just like I was talking about on Tuesday, remain another feather in the cap for the bulls. This is a way to measure risk appetite, and high yield bonds are leading these other two bond categories. So throwing caution to the wind going into the riskiest part of the bond market seems to be working here at the moment, and that's supporting the activity we're seeing out of risk taking in the stock market as well. One area that's not doing what you probably want it to do if we're in a really robust bullish market is Bitcoin. It remains kind of in this languishing underneath that falling moving average. So that's another sign of risk appetite. But in this case, it's really not helping the bull's case. This is one of the very few cases that maybe is in the feather of the caps of the bears here at the moment. And then let's take a look at the sectors as well. This is chart 5C. These will be the traditional market cap weighted sectors, not the equal weighted ones that I was mentioning before. So you guys should notice one thing when I pull this up. And what you should be noticing right now is that every single chart in front of us is green. When I said a moment ago that we were having a global stock market party, you start breaking it down, you're seeing that at the sector level too. You're not just seeing it at the broad level. All of these have green charts. Staples and utilities have that light green telling us that we have weekly bullish postures. All the rest are dark green with strongly bullish postures. So it has been quite the move that we've experienced. In terms of who today's leader was, let's see who it would have been. Was it the communications? Yes, it was communications. It was up 1.59% today. And then in terms of laggards, we didn't have a single sector that was down today. Again, confirming what we saw with 87% of individual stocks higher today. That was also claimed across these 11 different sectors that are out there. But some of them did not go up as much as others, and it looks like real estate is probably the laggard today. It was only up 0.43%. But, lots of bullish charts out there, that's for sure. The question is, are they getting a little too bullish, right? And that could very well be the case. All right, let's go ahead and get into our trade application example now. And, there were a lot of bullish trades that I wanted to take today, but so many of them have $5 wides on their options chain. I was not able to get them to work for bull put spreads. That's what I was hoping to accomplish. There were probably 4 or 5 different charts. I was like, okay, let's do this trade. And then I tried to put the trade in and it's like, nope, not getting filled. So that part of it was a little bit frustrating. So what I ultimately ended up doing, because I started to run out of time, as sometimes happens, because remember, I want to get these trades done before the market closes. So that way I can send out the notifications to those of you that are premium members on our Telegram channel. So what I ultimately settled upon here was actually a bearish trade, believe it or not, on Disney. So ticker symbol DIS, of course. And you can see that Disney has kind of that traditional feel to the chart, that it looks like it's kind of starting to roll over once again. Now, obviously, I don't know that to be the fact. Obviously, it's part of not only the S&P 500, but the Dow Jones Industrial Average. So if the Dow Jones Industrial Average has a breakout to the upside from that inverted head and shoulders pattern that I mentioned before, Disney would likely follow suit with that. So we have to be mindful of that. And that's why you always have to position size, accordingly, and make sure you're not risking more than you can afford to lose and all that kind of stuff. But why I thought this was at least a reasonable chart, first of all, you can see it's vastly underperformed the S&P 500 over the last 3 months. Not only that, but notice it's still down on a year-over-year basis when the S&P 500 is up 18%. And over the last 9 months, it's really ugly. Disney is down 17%. So this is a stock that's really struggled and has been more bearish than bullish over most of the last year. And right now, you had the benefit of seeing that reversion to the mean rally after getting these 3 straight days with oversold cluster signals. Eventually, that thing got some giddy up and go. But as is often the case, you usually don't have a trend-changing move when that happens. You have a reversion to the mean in the short term, and then it rolls over again. And that's what has me wondering, do we have that type of a scenario unfolding right here, right now with it? You'll also notice down below that we have something that appears to be close to a bearish near-term divergence, although it's not perfect on that count. But here you can see we have a peak in the blue line right here on June 7th. We have a follow-up peak right here that is basically equal to it on June 13th. The 2 candles associated with those 2 levels are this candle right here and then this candle right here. So obviously price went up when we had basically a topping out of the indicator down below. It's not a guarantee, but it's one other kind of excuse, I guess you could say, to maybe flirt with the idea of taking a bearish trade on this one. So what I ultimately did was just did a normal short sale on it, where I just shorted 100 shares of the stock, and I did kind of a bracket order where I have my upside stop loss. Remember, when you're shorting the stock, you want it to go down, so your stop loss is above you. And the area that I chose was a couple of pennies above the high of this gap down day here on May 11th. And then to practice our 1-for-1 rewards risk relationship, where I want it to go as my target price, where I would get out at profits, if that is what is in the cards, would be down here just a hair above 91. The other thing I was going to mention is I happened to have CNBC turned on after the market closed, and they were saying that the CFO of Disney is stepping down. And I was like, oh, interesting. I wonder if that's good news or bad news for the stock, because of course I just placed that trade just a little bit before the market closed. In fact, here's the screenshot of the telegram that I send out to our premium members, and you can see that I sent it out 10 minutes before the market close here. It is, it's got the timestamp and all that kind of stuff. Because I tried to do that just in case any of our members want to consider similar trades. Not that I'm encouraging them to do that, because I don't give recommendations, as I'm not a licensed advisor, but for those that want to consider it, I figure it gives them a slight information edge as opposed to waiting until the free video at night, and then sometimes the trade is missed. Sometimes that benefits us, sometimes it doesn't. It does work both ways, but I will say one thing that was interesting about this is in the after-hours session here, right when that news hit that this CFO, Christine McCarthy, was stepping down from Disney, the stock did go from about 93 to a low of about 92. So it dropped $1 in the after-hour session. It did recover some of those gains, and you can see that the final price here, now that the aftermarket is closed, is somewhere below 92.50. So not a home run by any means, but hey, every little bit helps, right? We shorted it above 93, and if we get some sort of a a fluke news item that helps our case in the after-hour session, that sends it down to below 92.50, at least we're heading in the right direction. You can see that these are some pretty tight stops that I got here, so we'll likely know very quickly, probably within a week or so, of whether we're going to hit our price target on the downside or whether we're going to get stopped out on the upside. So anyway, that was my trade idea for the day, a short selling idea there on the House of Mouse. I hope you enjoyed the presentation tonight. It was another exhilarating day in the stock market where we have a stock market party across the globe. If you enjoyed the video, I ask one thing out of you. Click like for me there on Twitter. That'll go a long ways for us. If we're up in over 100 likes by the time I'm scheduled to do the video again on Tuesday, I'd be more than happy to give you another full-length video. On the other hand, if these are getting a little bit too long for you, feel free not to click like, and I'd be more than happy to just give you a 15-minute video on Tuesday. So I'll let you guys decide collectively, but whatever you do decide, I appreciate you checking out tonight's video. David should be back with you tomorrow to give you his take on the weekend, and then I'll look forward to seeing many of you early next week. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.